These two men got together in college, started a hedge fund, and within 10 years, they had destroyed the cryptocurrency market and were facing a $3.5 billion debt. Zhu Su and Kyle Davis, two men who met in college, are the protagonists of our tale. Both were rather ordinary men with typical financial careers. They attended a prestigious boarding school in Massachusetts, completed their schooling at Columbia, and then began their training in futures trading at Credit Suisse. All seems to be well thus far. Well, the smallest risk is where it all begins. Our two heroes did something unique for a couple of lads in their mid-20s in 2012, that dependable year when the world was meant to end. Welcome to Cryptique, a channel that gives critical evaluation or analysis, especially in dealing with crypto. Everything regarding money, finance, investing, cryptocurrency, and blockchain-related topics including ICOs, NFTs, and yield farming. Please subscribe and share this video. Also, do hit that like button. They established 3 Hours Capital, 3AC, a hedge fund that, like the majority of hedge funds, is essentially a pool of investor money used to trade in liquid assets in the hopes of achieving spectacular returns. Yes, we will reach those conclusions later. 3AC was a small, unassuming company with a straightforward but uninteresting business model. Find price discrepancies in emerging market currency derivatives and take advantage of them to make money. 3AC was based in the British Virgin Islands and had a Singapore license to manage other people's money. You'll generate a respectable profit if you repeat this often enough. And this satisfied them for a while. But when 2016 arrived, the world of digital assets really began to emerge. Most people at the time found the realm of cryptocurrency to be novel, fascinating, and thrilling. But it was something much more to Zhu and Davis. It was a growing, active, and promising sector of the economy. Zhu believed it to be an illustration of Amari's rule, which states that technology will initially be overrated but ultimately be underrated. Like the internet, he thought that cryptocurrencies would fundamentally alter the world. .coms and the internet were questioned, yet look where they are now. But he and Kyle also noticed an oddity with crypto. There were a lot of pricing differences throughout the market. The very kind of price discrepancies they had spent the previous few years preparing to exploit. The timing was ideal for making money. As a result, 3AC entered the cryptocurrency industry and quickly became well known. Their method started out by investing in futures for Bitcoin and Ethereum, but they soon built up a solid, well-rounded portfolio. But more crucially, they mastered the art of borrowing money from many sources across the business. And it's important to comprehend this portion. They were taking out so many loans and investing the money in things they enjoyed, which means they were very exposed to the cryptocurrency industry. They gained such a solid reputation that they were assisted with brokerage agreements by Chase and the Bank of America. Additionally, they steadily but surely increased their leverage in the area. Our tiny hedge fund 3AC eventually expanded into a $3 billion giga-chad crypto industry behemoth. Always describing it the same way I did, giga-chads was Zhu and Davis.
Do it!
They backed it up on Twitter with statements that traditional investing was only for baby boomers. What a blazingly hot perspective, I know. They quickly became the industry's go-to people. But not everything went smoothly. They were managing company finances as well as arranging introductions and business agreements. They were also gathering Twitter followers and fanboys. Some claimed that they were utilizing Twitter propaganda to affect their very own revenues. I'll let you make that choice. Zhao criticized Ethereum. The price dropped once he announced that he was giving up the currency. However, Nansen Analytics reports that around a month later, 3AC purchased about 150,000 Ethereum. However, by 2018, Zoo made them well known. See, the state of cryptocurrency in 2018 was dire. Prices had fallen by 80% by September of that year, a decline worse than the burst of the dot-com boom. Naturally, investors were in a panic and there was a lot of end-of-the-world rhetoric. Zoo then entered the scene and tweeted, "We will pump off the bottom exceptionally quickly, leaving the majority of sideline investors locked in flat." And what about that? He was accurate. Crypto recovered and Zoo's tweet elevated him to industry icon status, which combined with his hypnotic new worldview started bringing in actual followers. He referred to it as the super cycle, which effectively suggested that Amara's law will eventually hold true in the field of crypto. This innovation would help spark a revolution and build a blockchain-based new internet. Crypto was going to fundamentally alter everything, not merely be here to stay. A huge concept supported by an even bigger bullish confidence about the market will bring rewards. HODL no matter what. Zoo stated, "I definitely think that once Bitcoin's price goes over $1 million, goes over $500K, it's going to be driven a lot more by larger players rather than retail anymore." Why is crypto anything different? Zoo and Davies, though, were serious. They held the view that crypto will be okay and that the only course of action for serious investors was to HODL. And what about that? People had faith in it. Their certainty was strong. And Zoo's 2018 predictions' accuracy just served to confirm this. With a nearly $700 million uncollateralized loan from Voyager Digital, they were able to obtain uncollateralized or partially collateralized loans from significant banks in the sector. This basically means that Voyager would simply kind of assume that 3AC pays it back if everything went wrong. Zoo and Davies were therefore in their element. What possibly could go wrong? Well, the only direction you can go when you're at the top of the world is down. That's exactly what took place after that. When a new player arrives on the scene, things start to go wrong. And they are too delectable for our educated investors to pass up. The Grayscale Bitcoin Trust, or GBTC, is the participant. And they're actually rather innovative. They not only enable consumers to own Bitcoins by functioning as a fund into which they can invest, but at first, they were the only US-regulated cryptocurrency products, which helped them quickly achieve notoriety. In fact, GBTC became so well known that the value of its shares traded above the value of the Bitcoins that made up the company. How heated these things can become is insane. But 3AC didn't find it to be tasty for that reason. It was tasty because GBTC provided funds like 3AC with backdoor access to the trust, enabling them to purchase shares at a lower cost than a typical trader. Here, the approach was basic. Your shares, which you acquired with Bitcoin, are now worth more than the Bitcoin you used to purchase them. Now, this gave 3AC a happy drool. This was the strategy. First, borrow some Bitcoin. Step 2 is to buy GBTC stock using it. Step 3 is to pledge the shares as security for a new loan. Risky leverage is piled on top of it. Nobody is shocked that 3AC was GBTC's largest holding at the time of its most recent filing, which was at the end of 2020. Where is it? Somewhere more than $1 billion. Things aren't perfect, right? Now, since a condition states that if you buy shares, they must be locked up for 6 months. Who cares, though, if you're using the shares as security? You can still utilize that asset right now. And if you think that crypto will continue to rise, as Zoo and Davies did, then there is absolutely nothing to worry about. Naturally, the price of GBTC changed in the beginning of 2021 when ProShares Bitcoin strategy ETF entered the market, causing GBTC's price to crash below Bitcoin and continue to decline. For 3AC, not good. But keep in mind that they have their hands in numerous pies. One of these pies were startups in decentralized finance. These businesses had an easy enough objective: take Wall Street and digitize it, including with its tracking, borrowing, and assuring functions, all on the blockchain but without the regulation. It's ideal. DeFi businesses required as many people's crypto funds as they could get, though before they could do that, to draw people inside, they required a pitch. It was easy. On the other side, DeFi companies were giving depositors double-digit rates. Anchor Protocol was one such DeFi company with a 20% return. Tempting material. I was moved. But you had to possess USD in order to receive the 20% rate. Do Kwon, the king of nutcases, invented the USD token. That ought to show you where this is going, but I'll still demonstrate. Though perplexing, the connection between USD and Kwon's second coin, Luna, was successful. USD had worth as long as Luna did. What does 3AC do then? They deposit in addition to borrowing repeatedly. They begin to get dividends from Anchor in February 2022. Invested between $200 and $560 million in Luna instead of stopping there. And as time passed, the combined value of USD and Luna eventually surpassed $60 billion. They were no joke. However, this is the point that things really start to go south for Zoo, Davies, and 3AC since the price of Luna plummets, sparking a crypto meltdown. This is what transpired. Luna plummeted. And 3AC, which was much overexposed to Luna, is now having trouble. It has accepted loans from nearly every major participant in the business, and as a result, it is significantly over-leveraged and unable to repay those loans. As margin calls start to come in, the issue just becomes worse. Nobody, from huge whales to little investors, is aware of how exposed 3AC is due to its lack of transparency. So, if you think this video has clarified some things for you, please consider liking it and clicking that bell button to be notified of our new videos. Also, you might want to consider subscribing to our channel. It'll really help us out. Back to our video. What do they then do? They start pulling money while peeing their pants. This is a lesson in the financial crisis. People grow desperate and leave as a result of the sharp decline in prices, whether or not they lose money in the process. Further driving down prices is this. It's a downward death spiral where fear only produces more terror. Exactly, this occurred in 2008 during the subprime mortgage crisis. Here, there is a significant distinction from crypto. When banks started falling in 2008, there was a large, fat central bank ready to swoop in and bail out everyone. Not really with cryptocurrency. Consumer safeguards for cryptocurrencies are minimal at best, and there is no one to clean up the damage. Therefore, everyone was out when the cryptocurrency market plummeted and it crashed badly. Everyone that 3AC borrowed money from, including Voyager Digital and their uncollateralized $700 million loan, suffered when 3AC started making loan defaults. This is horrible and merely causes further worry in the cryptocurrency market since more organizations, including Blockchain.com, BlockFi, BitMEX, and Therbit, all had some exposure to 3AC and caused more squealing. Now tell us what Zoo and Davies did. To discuss the likelihood of a bailout, they met with executives from a number of cryptocurrency exchanges. Wall Street's iconic play. I assume it has never failed before. Hey, our wager was a failure. Please provide a hand. Please, anyone. Unfortunately, it doesn't work out and the conversations basically advise them to go away. And is this actually unexpected? Currently, the cryptocurrency market is collapsing. Value production is the issue in the crypto sector. The similar problem affects numerous tech companies. Any price you set, if you're not making money, is somewhat speculative because we can't simply determine its genuine value. We could calculate the value of your company if it generates $1 million in annual revenue. But it would be considerably more difficult for us to determine a price if your company had $1 million in revenue but had no profits. In other words, Zhu and Davies were here, their own worst enemies. How then did the tale end? Voyager Digital did indeed file for Chapter 11 bankruptcy. Numerous investors lost access to their money due to industry-wide 3AC exposures, which had a negative impact on people's lives. Still struggling, the cryptocurrency market has been instructed to liquidate 3AC, and 3AC was left with a $3.5 billion overall bill for 27 creditors after the dust had settled. A shockingly harsh blow to the cryptocurrency market, but an absurd accomplishment for a 10-year-old hedge fund. Nobody genuinely knows where Zhu and Davies are. As for themselves, nobody knows either. They seem to have disappeared. No one knows where they are, I'm serious. They haven't cooperated with the liquidators thus far. However, there has been some character development. Zhu made a reference to his former supercycle hypothesis, which supported the idea that the price of cryptocurrency could only rise. Yes, he openly acknowledged that he had made a regrettable mistake. And with that, this concludes our video. Acquired a lot of knowledge from this, we recommend checking out our other relevant videos from our channel. Also, consider sharing this video to any friends or family members who might find it useful. Until next time!